Hi, everyone. I'm Ben Burston, Chief Economist and Head of Research at Knight Frank. Welcome to the latest episode of our Property Perspective, talking all things commercial and residential investment in Sydney today. I'm joined by two of my colleagues, Mark Litwin, Head of Investment Sales for New South Wales, and Anthony Pirrottina, Joint Head of South Sydney. How are you, gents?
Very well. Happy to be here.
Well, we've been through a very turbulent time in the markets. Over the past few years, we've seen a downturn to varying degrees in commercial markets. We've seen a lot of volatility, partly related to the big spike in interest rates that we saw a few years ago. And just as we feel we're sort of coming out of that, we've got some new issues to deal with, some new economic uncertainties in the form of the tariff news coming out of the new US. Lots to discuss and very interested to get your perspective on it. I mean, we've been participating in some roundtable discussions with our clients. I might start with what do you see as some of the themes that have emerged from those discussions? What is the sentiment in the market at the moment?
Thanks, Ben. I think the sentiment is still that there's a lack of transparency that we maybe thought we were hoping to expect out of the balance of this calendar year. We came out of Christmas with a sort of a forecast for lower rate curve or shallower rate curve over a longer period, and that was going to sort of offer up a stable bedrock, I suppose, for people to make investment decisions from. In and amongst all of that, we probably saw a recovery, let's call it, and a movement towards sort of more robust participation in the marketplace. I think what we're probably experiencing now more contemporaneously is what we're seeing come out of the US and that impact on potential macro policy is that this recovery is probably going to be a bit longer. I think we're probably still in somewhat of a recovery phase, if we want to call it that, if recovery is the right term, to more robust conditions, but it's probably just going to take us a little bit longer than what we had initially thought.
Absolutely. I feel like it's been turbulent for a little while now. Interestingly, this time around, or certainly this year, feels like we've had a few distractions along the way. Elections, tariffs, rezonings and changing to planning controls. And that's almost diverted attention away from, I guess, where things typically are focused, which is interest rates and government policy and the broader economy. So that, I think, has shifted the perspective of particularly of the private market. So it's going to be interesting to see, I guess, where the rubber hits the road now in the second half of this year.
And so where is the rubber hitting the road in terms of it? So we've got a lot of themes. I touched on the market cycle itself, and we've got economic issues overlay with that, and you've rightly recognised that there's policy considerations as well, all of which are influencing the different commercial sectors and resi development in different ways. But as we stand today, where do you think the activity and the appetite is stronger versus weaker?
There's definitely become, a divergence, we'd say, amongst the different asset classes in the market. From our point of view, we're obviously seeing a lot of interest in living sectors, be that co-living, established blocks of apartments. Construction and development is weak. I think that's been widely known over the past couple of years now, and it's probably gotten worse, I would say. It certainly hasn't improved. But then appetite for established assets, so be it vacant, rundown warehouses, similarly the same, I guess, standard of retail property. There's an appetite for that as a value-add play, but definitely development from the ground up, I'd say, is probably the weakest. Value in established and existing improvements is probably higher now than ever.
What about you, Mark? Do you think that's the same across Sydney or different in different locations?
No, look, I think broadly speaking, that is the same throughout Sydney. Certainly, the inflation that we've had coming out of COVID has put a lot of pressure on the financials to develop new stock. So existing stock has come into favor. Again, if we put the overlay there around sort of a declining rate program over the future, then you could expect some yield compression to come into the existing stock. And I think that there's going to be some people saying, yeah, replacement cost is probably the same as my development cost, but without the risk. So why wouldn't I? What I think has happened as well is with that rapid inflation piece that we had over the last 24 months, 30 months, is, the developer pool has been filtered considerably, and it's very high quality parties that are in that space now. And the groups that are actually, there's a lot of people still very acquisitive for future development supply for residential stock in Sydney, because we do struggle with a fundamental lack of supply. But that the ability to deliver it is I guess, challenged a little bit because we are left with fewer players. They're more sophisticated. When they build the building, they get it done and they get it done right, sort of thing. So I think that where we see Anthony's market in this residential living sector space taking off as a result of that, people still want to be in this asset class. It's harder to build into it, much easier to buy into it.
And I imagine I can understand why it would be attractive to buy into it at the moment, because we've seen quite a bit of rent growth. It was widely documented, given the political, the widespread coverage in the media and the focus it's had in the political debate at local, at state, at national level. It's been widely understood the shortage around housing supply and the commensurate rise in rents that we have seen. So I take it from what you're saying that there's a lot of appetite to sort of buy into that latent rental growth and the expectation that the market will be tight for some time to come. But notwithstanding the fact that we do have ongoing supply challenges, it's probably less about the fact that it's difficult to meet feasibility thresholds from a sales perspective is more what's holding us back. Is that right?
Without a doubt. And I think Mark touched on it as well. There are many instances where you can purchase an established asset for similar and in some cases less than its replacement value. So there are many groups and private families who, whilst they may have done developments in the past, even as non-developer or non-builder developers, I should say, now they almost skip that stage, buy an existing asset. It may need some cosmetic work done, but at the end of the day, their exposure is still to the residential market, right? Obviously, we've seen very strong rental growth. Vacancy is still super low relative, I guess, to the rest of Australia and the world. So that's why I think there's that confidence that there'll always be a tenant. The downside is limited, and even the vacancy risk is so low. No one talks about an incentive on a residential lease. Like, it's as simple as that.
So I think we'll come back to some of the commercial sectors, but just continuing with discussion on the development. I mean, the state government has made significant efforts through the TOD program, other initiatives as well, to open up more land supply. So the intent is there to sort of pave the way then to more supply, but it sounds like there's other impediments in the way. I mean, if you could just add a bit more colour to that and perhaps talk about how it's impacting different locations, I think the listeners would be very interested.
Yeah, I think there's sort of two stories to Sydney's development and delivery marketplace. And in some locations, we just find that economic feasibility just straight up doesn't work. The rise in cost has outpaced the rise in revenue and projects are mooted. And ironically, that's really kind of where Sydney needs the stock. These are emerging markets. That's where a lot of young families move to because they're sort of more affordable, but it's a massive constraint. Whereas we go to other locations in Sydney that have experienced sort of the TOD, transit-oriented development, or the LMR, the low to mid-rise housing reform recently, which are 2 of 5 major reforms we've had in the last 14 months. We go into markets where this policy might work and we sort of bump up against underlying land value for that original house. So we can put a consolidation of houses together in, say, Mossman or Killara, but ultimately those markets already have a really high value allocated to that single detached dwelling as it is. So it's not I think the government's on the right path here by putting policy together to increase supply, but it is on paper supply. You do need to work with local area experts to find out where the right deal will work, because they will, but that on paper supply is very different to the on the street reality of actually delivering it.
And to add to that, there's probably 2 magic numbers that we need to have in our minds. $600,000 and $650,000, because that's probably across the board the hard cost to build an apartment today. So the average unit to a developer is going to cost them, just to build the building, $600,000 to $650,000. And the second number that we should keep in our minds is 1.2 mil, because 1.2 mil is really the trigger price for, if you can't sell a finished 2-bedroom apartment for 1.2 mil, then working backwards, 600, 650 grand to build the apartment, land, time, making some money out of the project, all of a sudden all of that starts to fall away. So 1.2 is basically the line in the sand. From our market point of view, that looks sort of like North Strathfield, Rhodes, marginal on Homebush, Like it's that real edge of the inner west, as we call it. That's sort of once you start going west of that, where the GR falls below that, pens down.
That's really interesting. You got two magic numbers there. So if we think next 12 months, and if we think your first magic number around construction costs, so if we sort of if we assume for the case of a debate that's unchanged, that we've obviously seen this huge spike in construction costs. So if we imagine that the 600 is still 600 in 12 months' time, if we imagine that the 1.2 is 1.25 or 1.3, if we get a little bit of apartment price growth, which we might expect as we come into a lower interest rate environment. So I'll throw a third magic number at you, which you didn't mention, but what were the cash rate to move the low threes or call it 3%. So longer term funding costs then come down commensurately in line with that. But which locations would you think are then, marginal at the moment, but if we have a slightly higher sales price and we have a slightly lower funding cost for developers, which are sort of the next cappers off the rank in terms of where might you see the next wave of supply coming through?
I think what that does instinctively, it moves the line further west, right? Where like if those $900,000 apartments are now 1.1, they start to become marginal, where as of today, they're no-go. So I think my instinct would say to me, anything slightly west of those suburbs I mentioned previously, South Sydney similarly as well, if you go Botany and further south, Caringbah, Miranda, it also starts to unlock those I guess, slightly further inner ring suburbs.
There's some numerical challenges laid out there in terms of those magic numbers. I might just come back to you, Mark, on the North Shore debate, where it seems less that some of the challenges are perhaps more intangible in the sense that they're not related to sort of a construction cost versus sale value. It's more due to the higher values of existing houses that you referred to. Is there anything that the government can do or should be doing to sort of unlock that a bit more quickly, or is it just something that it's just very difficult to move the needle on?
I think it's probably more the latter, Ben. I think this is something that's just going to take time to work its way through. The homeowner that built a house 3 years ago, 5 years ago, is going to struggle to see development upside as a result of this reform. That's why I say it sort of goes back to, as cliche as it sounds, go back to your local expert who's got the knowledge to understand which of the houses, for instance, in the street can sort of stack up to make a deal. I think if the government just looks to, and this is the state government, if the government, if we were to throw it back to them after they've gone through all this reform in the first place and say, hey, we need more mass, we need more height, we need more density, whatever it is to make this thing, financially feasible, I think that all that will do is put more pressure on local governments to use tools within their DCP or their development control plan to sort of slow down that delivery of stock. I think a lot of councils feel like they've had this foisted upon them. So I think it's probably more about, it's going to be a case-by-case basis where development opportunities can logically unlock. And that's that whole piece around the on-paper supply looks like something, but the on-the-street delivery is very much going to be something else. It's not unlike Sydney to have precincts that have been rezoned for 10 plus years, still working their way through the development program.
And there are some levers that can be pulled to, I guess, accelerate that. It might be a reduction in contributions to the council, or it may be some sort of a policy change where there's an incentive to actually get groups developing again. But without those things happening, and they'd be pretty extraordinary measures, because we're probably not that I can remember seeing that before, as Mark mentioned, it's just going to take time.
So you've talked about some of the challenges there delivering conventional resi development at the moment, but there's a lot of appetite from both institutions and privates, must be said, for to get into to broaden their portfolio to encompass living sectors. And I would have thought, South Sydney, where you're expert, Anthony, that would be a sort of a targeted location for that. Are you seeing much movement there? Are you seeing the emergence of co-living?
Absolutely. I think it's probably co-living has been the theme of 2025. If BTR was 2024, it's co-living 2025. And it's many of the same groups that have just, I guess, pivoted and seen it as an extension of their BTR offering. Certainly, inner South Sydney, anywhere basically that has amenity and proximity to transport, universities, retail hubs. Interestingly, I think we're starting to see that spill out into the inner west as well, which the inner west was probably not seen as a co-living market over the past few years, but we're now starting to see that. And I think it's just a function of, if you can't find opportunities in your first, I guess, basket of target suburbs, you'll then expand that. So now we are starting to see that as well. Marrickville's obviously been one. There's one happening there of scale, which has been well reported. There's a few others that we know of that are in the works as well. That's a bit further west of that. But certainly co-living is starting to, it's going to be a real thing, put it that way.
And in South Sydney, I mean, coming back to your magic numbers, where I would have some of the South Sydney markets, the values are higher.
Yeah.
And so the preference and the growth that you're seeing in co-living, is that because, is it the nature of the sites, or is it something to do with just the financial metrics that make it more immediately viable?
I think it's both. The co-living purchaser looks at the site through a very different lens to what a traditional build-to-sell developer will look at it through, which now we've definitely reached that point where the BTS, the build-to-sell buyer, actually is being outbid by the co-living buyer. So that's interesting. I think it's just a function of you can get more rent on a rate per metre of building, I guess you'd say. But then also their view is much more longer term. They're not looking to really buy, build and make money at that point in time. It's almost like a break even or vows to substantiate the holding cost. But then they take a view for the next 10 plus years. This is where we're going to rely on rental growth and that's where we're going to really make our money.
Now, we segued there into a bit of detail on ResiDev. Coming back to the commercial sectors and reflecting on the discussions we've had, Mark, I mean, where do you see the suburban markets at the moment? I mean, it links in, I think, with some of the discussion we've had on resi development, but how are you seeing the commercial investment space on the North Shore at the moment?
This is a question coming from our economist with the crystal ball vision, right, Ben?
Absolutely.
Look, interesting question. I don't mind saying that I find the vision on that still a bit less transparent than where we were obviously in that hyper low rate environment. I think the suburban marketplace is still looking at office buildings as potentially sites for adaptive reuse. I think entities, tenants, corporations, et cetera, are sort of in a bit of an elastic response as well to how they set up their offices and landlords and working with them. I think by and large that's filtered through, but I think there's still a sentiment of there's a lot of vacancy still in the market. Incentives are still really high. So if you go into the suburban marketplaces right now and you look at sort of B and C rated stock in the private ownership space, I think there's a lot of questions that are being asked around those sort of family boardroom tables about what do we do. I'm aware of examples in the North Shore that are going through adaptive reuse strategies right now. You can take a sort of a B-rated office building on the fringe of a metropolitan commercial marketplace, and that might transition into a self-storage facility now. So I think there's probably on the other side of that, from an investor's perspective, it's probably very opportunistic. We are headed, at least at this point, into a decreasing rate environment. There should be some associated cap rate compression over the longer period or over the near term, probably more appropriately. But what happens with the tenant and the rental growth is still a big question that is still ironing itself out.
It does. You should feel free to throw the question
back
to me.
Yeah.
I get that too. But look, it has been challenging. I mean, it's been a little bit easier in industrial markets where we've had strong rental growth really across the board, not only in Sydney but nationally, which has acted as a counterweight to the yield expansion that we've seen. And South Sydney's been front and centre there. Do you think, is that still ongoing, or have we sort of reached a point where at least we're sort of stabilised for now, given a bit more supply coming in?
I think if anything, it's actually come off a little bit, probably as much as 10%. Similar to how resi rents ran and then got to a point where they almost became unaffordable. Same thing with industrial. A typical 1,000 square metre shed in South Sydney is now getting north of $500, $550 a metre. So for if you think of a typical business having to pay $550,000 a year in rent before they worry about any of the other costs or make any money, it's certainly, you've got to have a really good reason why you want to be there. And with connectivity now through to the southwest being as good as it is, the rents fall away considerably. For a 20-minute drive down West Connects, you could almost halve your rent. And that's why those markets now, they ran really strong. And now we're starting to see them come back.
But where do we go next? I mean, a couple of years ago, there was a lot of talk about multi-level industrial as being the answer, and South Sydney being the obvious candidate, given the higher per square metre rates. I mean, we've seen a few examples. I mean, do you think it will? Have they been? Is it perceived to have worked? Do you think we'll see more of that?
It's very interesting. So as we speak, there are brand new multi-level developments that have just been completed. It'll be interesting to see what the take-up is like. Yeah, certainly. I think everyone's got their eyes on them. There's a couple of very well-known examples. Institutional grade product. Upstairs product is obviously very good and very sought after. Downstairs in a multi-level will be interesting to see, whether you need to discount it or whether there is a separation of the profile of tenant that likes to be in a upper level or a lower level. It's going to be really interesting to see what happens there.
Well, it's very common overseas, isn't it? We're frequully we're told that it just isn't. But are Australian tenants
we have
equally
to
prepared to
go? That's
go?
going to be
That's right. There's a lot of pent up demand there for South Sydney. I mean, if I turn attention then to another growth area of Sydney where there's more potential to expand stock, and that's the northwest, where we've seen obviously the advent of the metro, and more than in other parts of Sydney, there's substantial scope to increase residential supply. And historically, we've seen that through greenfield. Now we see increasing apartment supply. I know you're very active in that space, Mark. I mean, what's the sentiment in that market at the moment?
The Northwest Growth Corridor is still stable, strong in certain precincts. So stable to strong would be the rating in my mind. It's it's an infrastructure-laden growth corridor, very strong government strategy to release that land and sort of enable opportunities for our emerging population. It's all very modern in that sense as a result, right? So, the retail amenity it's very lively. It's got that theme of placemaking to it, and it offers everything that you could want if you are a resident in that area. You've got all of the purpose-built eat streets, movie theaters, entertainment precincts, and they're adjacent to the employment zones as well. I mean, this has been a big part of the Northwest, is making sure that, and the Southwest for that matter too, is making sure that we have employment opportunities that are adjacent or within proximity to the lifestyle opportunities. So it's a market in the Northwest where we do see those magic numbers that Anthony was talking about earlier around the cost to build plus the risk and the profit to actually deliver stock. We did close to $500 million in site sales in the Northwest for unit blocks alone in the last 12 months. And that's a pretty strong, indication about the appetite from that marketplace. Again, recognizing that COVID left the high quality players. If the high quality players are investing into that marketplace to that extent, it's a really strong signal as to its resilience and ability to carry on.
Probably also shows it's the potential to scale in that it's earmarked for large-scale development. It's the transport infrastructure is there. There's the ongoing outlay of retail development. Perhaps there's the hope that in offering scale, it enables it to achieve feasibility more quickly. I mean, is that necessarily the case? Though Anthony's talked through the magic numbers around sales values. Is that easier to achieve in a larger scale development, or is it not necessarily the case?
Oh, look, certainly I think when you get into larger projects that are longer running, they become delicate at a point in time. Too much can be too much. But what we see with the scale of the offerings in the Northwest, and if you look at, say, the Castle Hill Showground precinct, for example, sort of the smallest opportunity we've sold there was about 250 apartments in one hit. The largest was about 900. What that does is that drives confidence in the value chain of the developer profile, so financiers, investors, this sort of stuff, that there's enough evidence there to support the initiative in the first instance. So whilst 900 may sound like a lot, that'll be up to the developer to manage over a 7-tower program. They might put the back 2 towers as sort of a build to rent or co-living when they get there. That's what they'll figure out with scale. But on the whole, these precincts have enough scale that they drive confidence because there's evidence in place.
And the developer profile goes hand in hand with all those things that you just spoke about. They actually are the quality developer builder actually needs scale to make it efficient and actually make the project feasible from their perspective. So it seems counterintuitive, but it's almost easier to sell a site that's 300 apartments than what it would be if it was 30 apartments.
Which is counterintuitive in a sense,
yeah.
But it just shows the need to be granular with the way you're looking at it, and I've speak to experts such as yourselves. Well, thank you very much. I mean, it's been a great discussion. Just to close it out, I just thought I'd ask you for one theme and one opportunity that you see in your respective markets.
I don't see the supply issue being resolved anytime soon. I think any opportunity to purchase, be it a block of apartments or a single apartment, a two-bedder at $800,000. I mean, there are blocks that we sell where you can buy a block of apartments for $550,000 each. We'll look back on them 3 or 4 years' time and think what good buys they were.
What about an opportunity? If not development, where do you see what's going to remain strong then?
I think established assets, so finished buildings, will remain strong, particularly those older style buildings. Maybe they were built in the 60s, old warehouses, old shops in good locations. I think they'll weather the storm for sure.
Yep. Comes back to the fundamentals of real estate. Something can't easily be replicated. What about you, Mark?
Yeah, no, I'd second that. I think the existing stock, and if you can line yourself up into a precinct that is enjoying some of this reform or premeditated reform, that's just icing on the cake. I think, my thinking for the next 12 or 18 months is that this recovery, if that's the term that we're using, is just going to take a little bit longer, but we're on that path. We are on the path to a lower rate environment, albeit maybe slowly. And I think this residential living sector's asset class is the way to go.
I concur. I think we will see more of that. I think that, while some of the hurdles will remain, some of the other issues, some of the funding cost, I think we will see, for at the very least, a softer patch in terms of construction cost growth, slightly lower funding costs, and the gradual creeping upward of rents and sale values will help us get more stock out of the ground, both in terms of traditional resi development and also commercial living sectors. Well, thank you very much, gents. A wide-ranging discussion as ever. Thank you for your time. As ever, for our listeners, do get in touch if you have more questions or want to dig into the markets in any more detail, but we'll leave it there.
Before you go, subscribe to our channel so you don't miss out on the next episode of The Property Perspective, when we'll be back to share our take on more key trends and topics shaping Australia's property market. You can also follow us on LinkedIn or visit our website at knightfrank.com.au for more information. Thanks for tuning in. It may be the end of the show, but we're always your partners in property.